Good evening, everyone, and a warm welcome to the webinar. My name is Neeraj Kotin, and I'll be the moderator for today's session. I'm part of customer interaction team at Quantum Mutual Fund. First, let me thank you all for taking out time on Thursday evening and joining us for this session. We'll also request everyone to use their headphones for better audio clarity. This session will have approximately 30 to 45 minutes of presentation, and then it will be followed by Q&A. You all can post debt or fixed income related questions in the chat box once the presentation is over. As you all know, the topic for today's session is your debt portfolio positioned for higher interest rates? RBI actions have pushed interest rates significantly higher over the last 1 year. Currently, bond yields across the maturities are trading close to their early 2019 levels. Our fixed income team believes that the worst of inflation is now behind us and interest rates are near their peak in this cycle. It is time to look beyond the market noises and spot the emerging new trend. Hence, in today's webinar, our speaker will answer the questions like, does your debt portfolio require some strategic shift in the current market environment? How can you position your debt investment to beat inflation? How to avoid credit and liquidity crisis? Before we start, let me introduce you all with the speaker for today's session. Our speaker for today's evening is Mr. Pankaj Pathak, who has over 11 years of experience in fixed income investments and research. He is a qualified CFA. He joined Quantum Asset Management Company in August 2013, and at present, he is the fund manager for Quantum Dynamic Bond Fund and Quantum Liquid Fund. Without taking much time of yours, we'll request our speaker, Pankaj, to take the session. Over to you, Pankaj.
Yeah, thank you, Neeraj. And thank you all of you for joining us this evening. Now, as Neeraj told you that we are going to discuss about fixed income. But before we go into what is happening in the fixed income market, let's spend some time understanding the foundation of investing and asset allocation. So, yeah, sorry. Now, the first principle of investing or asset allocation is that don't put all your eggs in one basket. And if you look at this table, it tells you that, yes, we need diversification because different asset classes behave differently in different market cycles. So sometimes you see equity doing well, sometimes it doesn't do well, and same with gold or bonds, which in turn is fixed income. So this table shows you return of these asset classes, equity, gold, and bonds over last 15 years. For these are annual returns. So you can easily see that the top performer or the bottom performers are not same. Means all the asset classes, they have their own cycles, right? Just for example, if you just think that you are investing in 2007, when equity has given phenomenal return of 49%, whereas bonds were laggard. But immediately in 2008, if you are invested 100% in equity, almost half of your portfolio was gone by that time. So that's a big risk. And there comes the diversification that you invest across all asset classes to get better on your investment portfolio. So, and this is how the different asset classes add value to your portfolio. Now, you can think of it as a holistic portfolio where different departments act differently and try to get the best outcome. Now, equities, the whole objective is to target long-term growth. Equity has a very long history of wealth creation globally, not just in India, and it will remain a good avenue for wealth creation going forward. But the issue is that equity prices can fluctuate a lot. it can go up very sharply and it can go down even very sharply. So that's a big problem. If you need money or you want to withdraw from your portfolio at a time when markets are down, just you can imagine a situation in 2020 or in 2008 when there are a lot of layoffs and people are facing losses in their businesses, and you need to withdraw from your portfolio, and that time your equity portfolio is down, that can hurt us badly. So we need diversification. Now you can add some debt, which can lower the volatility, which has a much lower fluctuation compared to equities, and it can also provide you regular income. So that can add some value in the portfolio. Then we can add some gold, which has a very long history of managing the macro risk. So we saw that happening, be it 2008-9 crisis or in recently during the pandemic. When you need this protection, gold has always stood its ground. So the combination of equity, debt, and gold can act very well over the long period and across all kind of market cycles. Now, to meet that diversification need, we at Quantum have tested this 12-20-80, or what we call as even 12-20-80 asset allocation strategy. Now, what is this strategy? First thing first, look at safety. So safety, you need to keep some money at a safe place so that whenever you need that money, there is something available without much of impact on your portfolio. So what we suggest is we should at least keep 12 months of our monthly expenses in liquid fund, or if you have a safe debt category or the bank fixed deposit, wherever you are feeling safe, you should allocate there. But 12 months into safe portion in the liquid fund allocation. And then the rest of the portfolio, you can divide into two parts. Now, as I mentioned earlier, that equity has a very long history of wealth creation, and we believe this trend will continue. It will continue to deliver a significantly higher return compared to other asset classes. So bulk of our allocation should go into equities. And then, so in this allocation, we can allocate 80% in equities and the 20% into gold, which as a diversifier in your portfolio. So the 12-20-80 can work across all cycles without having putting any pressure on you whenever you need some funds. So you always have some backup. Now, to have a allocation within this strategy, at Quantum, we offer both active and passive funds, which can meet all your requirement for this asset allocation strategy. Now, within the active strategy, as you can see, we have Quantum Liquid Fund, where you can put the 12 month of your expenses, the 12 part. The 20% gold can go into gold saving fund or gold Quantum Gold Fund. And the equity portion, you can divide across various strategies. So now there are different strategies, value strategy, growth, or now in the ESG. So you can divide within the Quantum portfolio basket. We can have 15% in Quantum long-term equity, 15% in Quantum ESG fund, and 70% into Quantum equity fund of fund, which in turn give you a diversified portfolio of 79 mutual funds, which are not managed by Quantum, which are actually external mutual funds schemes where this fund of fund invests. So you get a diversified portfolio across various styles and various fund houses. Similarly, if you're more fond of passive investing, instead of going into all these style of investing, you can allocate bulk of your investment into Quantum Q Nifty 50 ETF fund of fund. And again, we should keep some allocation into Quantum ESG fund or this ESG strategy, which is more sustainable way of investing and can deliver a significantly better return over a longer period of time. Now to ease this process for you, at Quantum, we have a very beautiful calculator where you can make all those changes if you want. If you want to keep higher allocation for, say, your emergency corpus, instead of 12 months, you want to keep 24 months, or you have a different plan towards a gold or equity allocation, you can make all those changes. You can customize as per your requirement on this platform. If you are confused, you can just put your circumstances, your investments, your expenses, and this calculator can suggest what kind of allocation you need to do to various asset classes or various schemes. And good part is you can invest in few clicks, only few clicks, and you can allocate your fund to the entire strategy or the entire basket of funds with very easy way. So now let's spend some time how this calculator works. Now, as you can see that you can just enter what is your total planned investment in this column, and your monthly expenses. And there you have this 12, 20, 10, 12, 80, 20 allocation. And if you want, you can make the changes here. You can change, and accordingly, the calculator will make those adjustments. And as you press on continue, you get this allocation table, how your money will be allocated to different schemes to meet this 12, 20, 80 allocation requirement. So it can bring a lot of ease in terms of using or investing at the Quantum platform. And if you see the past history of this strategy, we strong believer of this strategy, and it has worked through the cycles. And since inception, if you see the weighted average return, it has been close to 12.66%, a decent return on a diversified portfolio with a safety backup of 12 months of expenses. So it has stood its ground since inception. So again, I'll reiterate, this is one very good way of allocating asset. Focus on diversification. Evaluate this strategy. Please visit our platform, our website, to check out this calculator. It can work wonders for you. Now, with this, let's move towards the fixed income part. And so last 2 years have been challenging for fixed income funds. And most of you who have invested in especially debt mutual funds, or even in case of fixed deposits, because their rates have been also reduced over the last 2 years, and now they have started picking up. Most of the fixed income investors have to live with lower return over the last 2 years. And some even face losses recently. So let's see how the fixed income market is set up and what is the outlook. Now, the biggest news around fixed income market has been inflation. And it's not just in India, it's a global thing, and it's actually a global problem. We have a sea of red here, which is showing inflation across the globe is at very high level. Now, first on the global stage, because we in India have lived with high inflation for a long time, and in terms of our inflation, we are not facing that much of problem. I'll come to that later. But globally, it is a big thing and big talking point, especially in the advanced economies. Now, if you look at this chart, this shows the IMF projection for this year, for 2022. This is average inflation for 2022. And you can compare it with the past trend. So before COVID, most of the advanced economies, they were struggling to meet their 2% inflation goal. Many of them were actually trying to push inflation higher by printing a lot of money, by keeping rates near zero. Many economies' rates were even negative. If you remember, even 2017, 18, during that time, we had high yield bonds trading at negative yield. So just imagine, look at the paradox, this high yield bond trading negative yield. And now we have a very different situation here post-COVID. when they are dealing with very high inflation. The average for advanced economies, as per IMF, will be around 7.2% in 2022. Even emerging economies, for the last 10 years, emerging economies also had a relatively lower inflation than their past. And that has also picked up in the last 2.5 years. So if you remember, during the COVID period, when there was a lockdown, most of the economies, their central banks printed a lot of money, especially in the advanced economies, and kept rates near zero, interest rates near zero. And on the other hand, government, they kind of writing all kind of big checks and giving handouts. Now, if you get money, if large part of the population get big checks in their account every month, what they do, they go and buy things, and that's what happened. The consumption that boosted consumption, and economies rebounded quickly. Means if you remember those forecasts before, when we were hit by the COVID, most of the economies got surprised later on because economies rebounded quickly. But it has its own side effects. Now, side effect is inflation. At consumption got a boost. People started buying things, but there was the supply chains were not fully in place. And commodity prices started rising and all kind of steps happened. And that led to a spike in inflation. And then we had this war at the start of this year between two large commodity exporters, especially energy and food, that again added to inflationary pressures. So this is the story. This has already happened. Now, where we are heading. Now, if you look at the IMF forecast, and most of the economists on the street will have a similar kind of trend line going forward, that inflation is expected to ease in 2023 and 2024. It may not be entirely due to durable reduction in durable inflationary pressures, but even the math, the base effect is going to reverse. So we can see it as a one-time price settlement. Like if you had a crude oil price around $75 last year, and today it's $100, that means 30%, almost 30% rise in the price. But if it remains around 100 for next 1 year, the future inflation on crude oil will be zero, right? So if prices stabilize where they are at their high level, it will automatically have its own base effect, and this spike in inflation will fade away. So a large part of it will be just the math, and inflation will reverse. But even on a durable basis, we are now getting some signs of stabilization. Supply chains are getting back on track. Central banks have been acting very fast and very aggressive, and the growth rebound we saw, that is kind of fading globally. So even some economists are putting very high probability for recession going into next year. So if growth slows down, and if consumption slows down, that will put downward pressure on inflation, and those things will play out in next year and maybe next year. From India's point of view, if that happens, that will bring some comfort, because the central banks in advanced economies have been very aggressive, especially recently in the last 7-8 months, when they started hiking rate to tackle the inflation. So if you see US Fed, which is kind of leading in this pack, they have hiked the interest rate, the federal fund rate, from 0% in March this year to around 3.75% now. It's a fastest rate hike since I think 1980. So in almost more than 40 years, we have not seen this pace of rate hikes. Similarly, most of the other central banks are also hiking at a very fast pace, and mostly especially this pace of rate hike is making everyone nervous, be it policymakers or markets. It's kind of sitting at the brink where people waiting for something to break because of the rate hikes. So if we get clear signs of inflation cooling off, that will bring some respite, and we'll see some of the central banks backing off or slowing down. No, we have some evidence that inflation has kind of peaked in many places, and even some of the central banks have slowed down. So, like we had a Bank of Australia and Bank of Canada hiking by lower quantum than what was expected. And even from the US Fed, the recent commentary suggests that the pace of rate hike will slow down. Maybe they will continue to hike, but not by 75 basis points. So last 3 meetings, they hiked the federal fund rate by 75 basis points in each policy. So if they slow down, even that will be treated as a positive because now market is set up for a very aggressive Fed and other central banks. So now coming to India, our inflation is not that problematic. We also have a higher inflation, higher than what we target. So RBI targets to keep inflation around 4%. And most of the last 3 years, inflation has been above 6%. So that's a bit of a worry, but given the growth situation, RBI is comfortable with inflation below 6%. So we are not far from our target. Last month, inflation reading in September was 7.4%. For October, the expectation is that CPI inflation will come somewhere around 6.5%. We will get the number on Monday. But that's a big drop. And again, the math is going to play out. The base has reversed. And because last year we had a high inflation, this year when we compare year on year, that number will come down. So, but overall inflation is cooling off in India, and as per RBI's own estimate, CPI inflation will go down to 5% by middle of 2023, and most of the market forecasts are in that range only, very near to 5% band. So now looking at the global and domestic inflation, we get a sense that peak of inflation is now behind us. We have seen the worst of inflation in the last 1.5 years, and probably going forward, we will see inflation trending down. Now, the other side of this inflation cooling off is central banks. So how they will change. Now, much of the rate hike has already been delivered, be it foreign central banks, US Fed or Euro or Bank of England, and even in India. I mean, the RBI also started hiking interest rates and reducing liquidity. They've been reducing liquidity since the start of this year, but they started rate hike from May. And between May and September, the RBI hiked the repo rate by 190 basis points. That's significant, from 4% to 5.9%. And if you look at the market interest rate, that was hiked by even higher proportion, by 230 basis points, because they changed the flow. So if you look at the green line in this table, in this chart, the gap between the blue line and the green line was very wide before April 2020. So because RBI was keeping a lot of money in the system, banking system was actually parking their surplus cash with RBI on daily basis. Whatever excess money they had, they were lending it to RBI at reverse repo earlier, which was at 3.35%, which was 65 basis points below repo rate. Repo rate is rate at which banks borrow from the RBI. And reverse repo was the rate at which banks used to lend to the RBI their surplus cash. Now in April, RBI introduced a new instrument, which is standing deposit facility. Now this is the effective floor, and banks will lend to RBI under SDF, or the standing deposit facility. And this rate was set up 25 basis point below repo rate, not 65. So that was effectively 40 basis points hike in the interest rates before RBI formally begin their rate hiking cycle. So overall, they hiked the rate by 230 basis points. But if you look at the market impact, it is much more pronounced than what RBI delivered. So if you look at 1 year government bond yield, that actually moved up from the bottom of 3.5% to now closer to 7%, almost doubled, almost more than 300 basis points jump in the 1 year government bond yield. And similarly, all the corporate bond yields, etc., also moved up. Even at the longer end, means the movement was lesser because we have some, during the decline, it hasn't responded that much. But if you look at the absolute movement in bond yield, that was significant even at the longer end. You can read it through this chart, which shows change in bond yield. The blue bar shows how much they changed in 2021 in the calendar year, and the orange bar shows how much they've changed in this year, YTD, since the start of this year till October 31st. And you can easily spot that short-term rates have moved up a lot because RBI, one, hiked the reverse repo or the move from reverse repo to SDF rate. And two, they reduced the overall liquidity. They tightened the liquidity in the banking system, which affects the short-term rates more than longer terms. But even at the longer end, again, I see, as I said, that the absolute movement was huge. If you look at the 10-year bond yield, it has moved up by more than 150 basis points over 1.5 years. And that's a big movement for a long-term bond yield. So now, just to summarize these three elements, one, inflation has peaked, and now the worst of inflation is now behind us. Second, much of the rate hikes or the monetary policy tightening has already been delivered. I'm not saying they're going to stop, but they're going to slow down, and soon they will stop. We are getting to the end of very near to end of the tightening cycle. So again, next year we will have a very different macro backdrop for bonds. And third, the bond market has been repriced significantly. We have seen a very significant jump in bond yields across the maturity curve. And now, just to top up, the fourth element is that now we are getting a positive real rate across the yield curve. Now, there are a lot of myths about real rate. When you look at real rate and compare it with the past inflation, what has already happened over the last 1 year, that is actually lagging indicator. That's a very wrong signal. And we should always look at forward expected inflation, not the past inflation. And the expectation is that over the 12-month, the forward CPI will be close to 6%. And with that 6%, when we compare the bond yield curve, almost at the entire yield curve, we are getting positive interest income. So bonds are back. You can beat inflation with bond investment in fixed income securities. Though fixed deposits are still taking some time to get repriced, but bond market or the money market has already priced the rate hikes and the inflation. So these four elements, again, I'll point out all of them, that inflation has peaked, central banks are near the end of tightening cycle, bond prices have been changed significantly, prices have fallen or yields have moved up significantly, and then we are getting real interest rate, positive real interest rates. So this is the backdrop with which we are going into 2023 very soon. And so that requires a major churn in your portfolio, in your fixed income allocation, and it requires some rethinking how we should proceed on the fixed income allocation. And now, if you look at the overall rate cycle, just to add on what I've built up till now, whenever we see the rate hiking cycle, market has tendency to front run the policymaker, and they act on expectation. So when we get some sign of inflation picking up, bond yields immediately move higher. And then RBI or the other central banks, they kind of play catch up. When they hike, we don't see bond yields reacting too much. And that's what has happened. So if you look at all these highlighted area in shaded blue, much of the bond yield increase, which is the orange line, has happened till the first or second rate hike. And thereafter, bond yields tend to consolidate. It moves in a narrow band, in a range-bound fashion. But much of the yield movement happened before the rate hikes get intensified. And that's what we are seeing this time again. So bond yield peaked somewhere around mid of June. That was the second rate hike when RBI delivered. So if I remember correctly, it was 11th of June. 8th June was the RBI policy when they hiked by 50 basis points. And on 11th June, we saw the peak 10-year bond yield near 7.6%. And since then, we have not been able to break that top. It has been consolidating closer to 7.20 to 7.50 in that band. And this is validated by the past trend that as RBI progress with the rate hiking cycle, bond yields tend to just consolidate and move in sync with the RBI rate hikes. So our belief is that again, bond yields will not be too sensitive to rate hikes going forward. We are already at 5.9 in terms of repo rate. Probably we'll get one or two more rate hikes, and repo rate will go to 6.5%. But from the bond market's perspective, that is already in price. I mean, it's widely discussed. It's part of market psyche, and market is not going to respond too much on future rate hikes. So now we have a limited upside on bond yields going forward. Our sense is that we are very close to peak of bond yields in this cycle. And this is time when we should look at adding some duration in your portfolio if you have a longer term asset allocation requirement. If you are, say, investing, or you have a longer horizon for, say, 2 to 3 years, you can have some allocation to longer term debt as well. So if you look at the yields, this is the yield curve, and the dark line, the black line, shows the recent yield curve, which is of 31st of October 2022. And you can compare it with the 2021 end. So YTD, how bond yields have changed for various maturities. And you can easily see what kind of yields are offered at various maturity points. So if you are investing in liquid fund, you'll be happy to know that now liquid fund in investing in 3-month treasury bills, which are yielding closer to 6.5 and not 3.5. So if a year back, or even at the start of this year, the 3-month treasury bill yield was closer to 3.5, and now you are getting 6.5. So a lot of improvement has happened even for short-term debt instruments. And even for the longer term debt instrument, because there is also a price element, and when rates go up, when market interest rates go up, their prices tend to fall. There is an inverse relationship between price and yield. And now, as we believe that much of the rate increase or the yield increase has already happened, we will see limited impact in terms of mark-to-market losses. And the starting yield or the accrual has improved a lot. Now, you can compare it with the three-year yield. So let's say if you are investing in 3-year bond last year, the yield was 5.3%. That was the starting yield. So if you keep your investment for 3 years, you will get 5.3% return. In between, if yields go up, you will face some losses, and it can reduce your return. Now that yield is around 7.2%. Again, that's a significant change. And if you hold your investment, if you buy a bond, 3-year bond, and hold it for 3 years, you will get close to 7.2% in form of returns. And that gives some opportunity for fixed income funds to generate slightly higher returns. So return potential across the bond yield curve or across debt fund categories have improved significantly over the last few months. And that is actually opportunity for fixed income investors. Now, to benefit from it, I would suggest you, if you have a long-term asset allocation requirement, or if you have a longer holding period and you can tolerate some volatility, because see, whatever happened, be the positive outlook, all the things I've highlighted, there's a lot of uncertainty. There is a war going on, right? And these are two large commodity exporters. We have a lot of geopolitical uncertainty, even in Asia, between China and Taiwan, and all those things. So there's huge uncertainty, and path forward will be volatile. A lot of volatility can happen, which we don't know about, right? So there will be volatility, but if we try to look through that volatile phase, if we can ride through that intermittent volatility, these yield levels are very, very good to get decent returns. Now, thinking about it, so as I mentioned, if you have a longer term horizon, you can look at slightly longer duration categories, especially I would say in the dynamic bond fund, where we have some flexibility and which can actually respond to these uncertainties if they play out. So the fund manager has flexibility to change the portfolio, and as situation changes, they can react based on that. But if you have a shorter holding period and you can't tolerate all this volatility, it's better you stick to liquid fund or categories like that. And there also you are getting decent return now. Means the return potential has improved significantly since the start of this year. So a mix of liquid or bond fund, depending on how much you can keep for a longer period, can work well for your fixed income allocation. Now, if you look at the past track record of debt investments for different level of yields, you find something amusing here. So one, if you are investing for say 1 year, why I am saying that you should keep longer holding period if you are investing in bond fund, because in 1 year the outcome range is very wide. And so this chart here, it shows the bond yield and the 1 year forward return. So like if bond yield is at 6.5% and you have invested, what has been your return in 1 year period, in the forward 12-month period? Similarly, this is for 7%. What has been your return? 7.5, and going up till 9. Right? So you can see how these dots have been moving higher, and this is past 20-year track record. So it has captured a lot of market cycles in between. So as your starting yield move up, you see your returns moving higher. But in the 1 year horizon, the outcome range has been very wide. So suppose if you have a starting yield of 7.5% when you are investing, over the next 12 months, your return could be closer to 3.7 to 4%. And it can go up to 10, 12%. So it's a wide range. Nobody knows. And depending on how things evolve over the next 1 year, your investment will perform. But if you are investing for, say, 3-year horizon, because rate cycles tend to normalize over this period, and most of time it has happened in past, and we believe it can continue in future. So the range of outcomes is much narrower if you are investing for 3-year period. So it gives you more certainty in terms of your return. You have a better view of future here. And if you look at the median, when starting yield is at 7.5%, median is somewhere close to 7.7% return, and that's a decent performance for a fixed income fund, especially in the current macro environment. So again, that long story short, if you have a long-term horizon, you can look at a fixed income fund based on your risk tolerance. But for your 12-month monthly expenses, or if you have a shorter holding period or near-term surplus, just stick to liquid fund. And again, liquid fund returns have improved significantly, especially for investors who had complained about liquid funds for the last 2 years, which was very painful when liquid fund returns collapsed and was very close to saving bank account rate. Now you see the returns improving significantly, and the gap between the saving bank and the liquid fund return, that has actually widened a lot. So again, you have opportunity to move from part of your saving into liquid funds, and your potential return will be much better. Now this is the performance, as I mentioned, that near-term returns are improving in liquid funds. So if you look at the 7-day return and annualize it, it is going to 6.07, whereas if you look at a 1-year return, which is comparing your return from the last year, that value has increased by only 4.17%. So as we progress, you'll see further improvement in the liquid fund performance as rates have already moved higher. It's a regular plan. Now, as I explained, again, the strategy is to choose between the quantum liquid fund and quantum dynamic bond fund based on your investment horizon and the risk appetite. But I want to emphasize on one thing about, especially for the quantum liquid fund or the liquid fund in general, that whenever you choose liquid fund, always have this safety first approach. And that's what we have adopted in our quantum liquid fund, which invests entirely into government securities, treasury bills, and few selected AAA rated PSUs. The idea is to keep credit risk to minimal levels. Now, again, this is not money to take very high risk, right? If you remember that 12, 20, 80, the idea behind 12 is to give you safety and some sense of peace, right? So you should not face any turbulence here. And in past, over last many years, we have seen a lot of liquid funds getting impacted due to credit defaults or the liquidity crisis. So in quantum liquid fund, we try to avoid that. We have zero exposure to private corporate debt. We don't invest in private corporate debt. And again, by keeping portfolio into high quality debt, into government and PSUs, we keep our liquidity very high in the portfolio. So you can see the portfolio is actually linked to credit, liquidity is linked to credit quality. And usually government securities and PSUs, they are the two highest traded segment of the fixed income market. So we never face any liquidity problem. And this is where we are adding safety and liquidity in the portfolio of the quantum liquid fund. And also, we always keep some buffer to meet all the redemptions so that we don't need to borrow to meet redemption. So there will always be some cash in the portfolio to meet redemption. Sometimes it will be high, sometimes it will be low, but it will always keep reasonable cash, which will be deployed in overnight assets. So when we say cash, it's not hard cash, and this is actually deploying money in overnight asset, which is tri-party repo or earlier, which was CBLO. So we get some return on that, which is overnight return. And currently, if you see, TREP's rate is somewhere around 6.2%. So we are getting decent return even on the cash portion. But it gives us flexibility to meet redemption without borrowing in the fund. So if you look at the performance again over the last cycles, it has this has actually worked well for us and for our investors, be it INFS crisis or MTech Auto or be it in COVID crisis. It has worked well. Now, if you remember INFS, the INFS was AAA rated company, right? When they defaulted. Now it's very hard for any fund manager to have that assumption that AAA company will default, right? But in our process, because we do not invest in private corporate debt, this INFS can never come to our portfolio in quantum liquid fund. And we were completely unscratched during that INFS debacle. Similarly, for the COVID-19, when we faced a big liquidity crisis, people were not able to sell, and many faced problem in meeting redemption. In quantum for liquid fund, means we had no problem in terms of raising liquidity. We also faced redemption, and we met redemption very comfortably without going to any borrowing or RBI's liquidity window. So this gives us some predictability over the future. And again, we will face more crises. Many unknowns will strike us over coming years. And our firm belief is that this process is going to work. And investors who are investing in liquid fund, they should prioritize safety and liquidity over returns. Now, on the dynamic bond fund, just to give you a brief, again, we try to keep credit risk to minimal level. It invests only in government securities and public sector companies, but it does take high or low interest rate risk depending on the market conditions. So the whole idea is to manage interest rate risk and make it kind of all season fund. So if interest rates are expected to rise, we try to keep our duration to low level. We invest in very short-term securities which mature early, and then we deploy that money at a higher interest rate. Or otherwise, price is inversely related to market interest rate. So when bond yields or market interest rates move higher, prices decline. And longer-term bonds are more sensitive to that. So if interest rates are rising, we invest in short-term bond. We avoid long-term bonds. And if interest rates are falling, we invest in long-term bond to gain more, to make our portfolio more sensitive and try to gain more in terms of market prices. So that's how the dynamic bond fund worked. Over the last 1.5 years, since we had a very cautious view. I think in August 2020, first time we wrote to our investor that it's time to tighten our seatbelt. And the whole idea was that now the rate cycle has bottomed and probably we are heading for higher interest rate. And since then, we kept our portfolio duration, or we kept our portfolio very less sensitive to rates. We invested in short-term securities. We kept higher cash than usual and tried to be conservative in terms of interest rate risk. And since then, we have been defensive. And then in June this year, we kind of become more comfortable with the interest rate levels. And now we are kind of at a time when we are adding some long-term bonds in the portfolio. So that is all on the fixed income side. Again, much of the macro worsening has already happened. And probably 2023 and 2024 are going to be very different from what we saw in 2021 and 22. So it's time to relook the fixed income portfolio allocation. And probably we have some opportunities in the fixed income space to capitalize on. With that, I will open the floor for further discussion and Q&A. You can post your questions in the chat box, and our team will pick up the question, and I'll try to answer all the questions with best of my capabilities. Thank you. So, Neeraj, we can now take questions.
Thank you, Pankaj, for your insightful presentation. As Pankaj said, please post your question in the chat box. In the meantime, we have received a few questions via email. So I'll start with that first. My first question to you, Pankaj, do you think interest rate will go up further?
So as I saw in the presentation that much of inflation and central bank hiking is now behind us, but they are not stopping, right? So they are still hiking, maybe at a slower pace, and that is already factored in. But there could be surprises if what if inflation doesn't come down, and that's a risk, right? So now with all our capabilities, when we assess and similarly for most of the agencies and market economists, there are signs that inflation is coming down. So if the baseline scenario plays out, if actually inflation behave the way we are expecting, probably we are very close to peak of rate cycle. But yes, there could be surprises. There could be some more increase in interest rates. But my sense is that that should be temporary, and it should reverse quickly if we go in that way. So from investment point of view, I think we have a decent yield on offering. So investors who have asset allocation requirement, they can actually look at these levels for investments.
Thanks, Pankaj. Next question would be, which category of debt fund is better in this environment?
So again, that depends on investors' own circumstances, especially their time horizon and their risk appetite. Now, mind for fixed income, this appetite or the psychology, that makes a lot of difference. Now, just to give you some example, we had a demonetization in 2016 when people deposited their cash in their banks and deposit rates collapsed. If you see deposit rate before demonetization and during the demonetization, we saw a sharp decline in deposit rate. And many of the people, they ventured out and hunt for yield and moved into fixed income debt funds. So one was long duration fund, which was showing kind of double-digit return that time. The past performance was good because we had a large rate cutting cycle before that, and also into credit funds. Now, the psychology, investor psychology, somewhere it was tuned that these funds are same as fixed deposit. But as it turned out in 2018, in terms of duration funds, when yields moved up, they performed poorly. Many of them delivered near zero return or even negative return. And by 2018 end or 2019-20, in terms of credit crisis, where many of them faced default and even lost their principal. So when you see those things happening, especially for the credit, means you have to be cautious and always keep that risk. But for the interest rate cycle, because there is still chance of recovery, right? When interest rates move up or down in cycles, and over the last 25 years, what we have seen, that cycle has been 3 to 5 year long. And you remain invested for 3 years, you have a very narrow band of outcome, as I shown in the chart. So the psychology affects us when rates move up and you see negative return. You should not panic. And if you don't have that temperament, I think one should invest into very short maturity, safe, liquid funds, etc., and should not venture around in very high duration. But if you have some understanding there that, okay, fluctuation can happen, it's not fixed deposit, you will not see daily increase in your NAV. NAV will fluctuate, even you will see some losses in an intermittent period. But if you keep your investment for longer period, returns will normalize and you will get somewhere closer to, as I've shown in the chart earlier, that 3-year return has been in the range of 6 to 10% for the last 20 years. So if you did that, if you keep that thing in mind and ride through that volatile period, if you have that temperament, then you can go into bond funds. Now, in the current situation, as I mentioned earlier, that there are a lot of uncertainties. There is war going on, all the geopolitical tension, and we are coming out of a big shock of COVID. And again, we got a different shock, is a very sharp monetary policy tightening, impact of which we'll be seeing next year. So all in all, there is a very high uncertainty, and I think we need flexibility in the portfolio. Now, if investors keep that flexibility with themselves by responding to changing circumstances, that will have a tax consequences, right? So if suppose you invest in very long duration fund now, and after 5-6 months, you realize inflation is not coming down and you need to change your portfolio. If you sell, you have to pay tax on that, which will be very high. And if you keep your investment for more than 3 years, you get a very big tax advantage. So I think during this phase, dynamic bond funds can stand out. One, because you get a professional who will be reading this cycle and responding to that. And second, you can remain invested for more than 3 years, and you will not face any heavy tax consequence. So I think dynamic bond funds are best suited in this environment.
Thanks, Pankaj. Next question is, if investing in debt fund can give returns up to 8.5%, especially in corporate bonds and short-term bonds funds?
See, it may or may not happen. Nobody has seen the future. But again, I refer to the same slide where I've shown the range of returns. So you've seen that when bond yields are near 7.5 on government bond, the 1-year return has been in the range of 3.5 to around 12%. And if you are investing for 3-year, return range has been closer to 6 to 10%. Now, these are past, right? This is past track record. It may or may not happen in future. But it does give us some idea that when we are in this range, what kind of accrual I'm getting. So let me tell you this way, the 3-year bond yield is around 7.2% now. If you buy a bond and hold it for 3-year period, on the government bond, I'm saying, you are getting 7.2%. Let's say you are you have some appetite to take more credit risk and you are investing in AAA bond. Now the spreads have narrowed over the last 3 years, and we are hardly getting any spread. It's 30 to 40 basis points at max, and you can add that, so around 7.6% on a 3-year corporate bond. So if you hold your investment for that period, this is what you will get. In between, in 1 year, if suppose rates move up, you will see some losses on your return on your bond holding. And if suppose yields actually go down, probably you'll see more than 7.6% on corporate bond holding in 1 year. So it may or may not happen, but yes, that is one of the possible outcome now. Yeah.
Okay, next question is basically based on our asset allocation strategy. Okay, in our asset allocation strategy, we say 12-20-80, where we mention only liquid fund and the portion of asset allocation. Why we are not recommending any fixed income product like a quantum dynamic bond fund in our asset allocation strategy?
Yeah, I get this question very often, and but broadly it has to do with investor psychology, because many of the investors, they tend to react when they see their bond NAV changing too much. We have seen that in when many people came in 2016-17, and even that time we had a similar recommendation that if you are investing in bond fund, have a longer holding period. have a 3-year view and then invest. But many of the investors who actually came with that view that, okay, I'll remain invested for 3 years, but when they saw losses in 2018, they started putting redemption and booking losses. And then returns stabilized. And 2019, 2020, we had a double-digit return, but they missed on that, right? And so investor psychology many times plays. Most of the investors have a limited understanding, and this tool we have built for a general investor who may not be related to financial industry, who may not be have that much of knowledge about how funds work. But in general, what we have seen that most of the investors who are coming to mutual fund, they have a fair bit of understanding how equity funds work, and they are ready for that fluctuation in equity fund performance. So that is a basic reason why we are not keeping bond fund there. And secondly, that 12-month expense, what we have mentioned, is kind of safety buffer, right? So that's a kind of a backup in your portfolio, and we should not take much of risk in this fund. But yes, this is a standard allocation, and every investor based on their circumstances can have a different allocation, and you can definitely take that view based on your risk appetite and holding period. Right.
Thanks, Pankaj. There's one question. There is a history that RBI has got its projection more wrong than right in the past. So why should inflation have peaked? What if inflation persists?
Yeah, so that can happen. There's no debate about it, and nobody has seen the future. It's not just the RBI, even market has gone wrong horribly. But in market, we have flexibility to revise or estimate without getting noticed. Whereas RBI, when they change their estimate, that becomes a headline. So nobody has seen the future, but we have to work. When you are investing in for future, you have to make some reasonable, some baseline estimates about future. And now what we see is that let's look at the dynamics, market dynamics, how it has changed. So for inflation, we had a big jump in petrol, diesel, all the fuel prices last year, right? And for the major part of this year, for last 4, 5, 6 months, we are seeing very stable petrol, diesel prices. So it's kind of stabilizing at that level. So we had a high inflation because fuel prices were rising in year-on-year terms. And now as they are stable, that will have a cooling effect. Similarly, for much of the food items, especially for edible oils, because that was a big driver of inflation for the last 1.5 years. And now that is actually falling for last few months. And possibility is that the fall will continue from the very high levels. So again, that is kind of adding some relief. On the other food items, especially cereals, we still see some pressure. But remember, we have a big buffer, a huge buffer of, it is not that high what we had going into the pandemic, but still it's a reasonably high buffer of food prices. And when food prices move up, that has an impact on political economy as well, right? So and that's the reason why this government has been very cautious about increasing MSPs, etc. So we have to make those estimates that okay, at some point we will see further liquidation of buffer to keep prices low. But yes, there could be surprises. But the baseline is that much of the increase in fuel prices has already happened. If crude prices again go up, possibility is that government will absorb much of those losses, and that's what has happened when food prices moved up and they reduced the taxes on food. Secondly, even global commodity prices have cooled off a lot since April, May, their peak in March, April. So that will also act as a act some cooling to the inflation trend. And then the base effect. So the 7.4 has a large base effect in play, and that's going to reverse. So all in all, we kind of agree with the RBI's forecast that inflation will trend down towards 5% by mid of next year. But yeah, the outcome band is again very wide. There is very high uncertainty, what I mentioned. But this is the baseline now.
Thanks, man. There's a question on quantum dynamic bond fund. What is the duration today, and what do you expect it to increase to? Assume I get into it after interest rate increase stop and get out after 3 years plus reduction of interest rate, post reduction of interest rate. What do you expect my CAGR to be?
Okay. No. Currently, if I say duration is in the range of 4 to 5 years in the quantum dynamic bond fund. But what is happening is that bond market is reacting to every small news flows, and there are a lot of fluctuation in the bond market, and that can lead to actually changes in our duration profile. Very frequent changes in the duration profile. So whatever duration we have built, it may not remain static over the period. We will see further fluctuation because market is fluctuating a lot. So, but general idea is that we will continue to add duration as we get more comfortable at the longer end. So if we see further rise in bond yield, probably you'll see our duration going up even further. And if we see sudden decline in yields, we will probably get more defensive and reduce some of the duration. But from investors' point of view, I think they don't need to respond to every market blip and focus on the more medium to long-term trend that much of the rate increase has already happened, and probably we are in some kind of consolidation range where rates may remain stable or fluctuate in a band, in a band for some time till we get more clarity on the future trajectory. So duration can fluctuate. Now, in terms of potential return, as I guided earlier, based on the past data, that the band could be wide for 3 years, as I mentioned, that it's a 6 to 10%. I think there is a reasonable probability that it should lie in that band. And given the current circumstances where we had a very sharp rise in yield, my guess is it should be at the higher side of the band, not at the lower side.
Thanks, Pankaj. There's a question on again a dynamic bond fund only. Okay, as we invest only safe kind of bonds, do we give up do we give up around 1 or 2% if we are not investing in a corporate bonds or any other bonds?
See, it depends on the strategy of the fund. Now, if you understand the strategy of the dynamic bond fund, the whole idea is to manage the interest rate risk. So whenever we see rates moving up or down, our expectation about rates, if we expect rates to move up or move down, accordingly we rebalance our portfolio. Now, if you say buy corporate bonds, I mean, the extent of yield you mentioned, 100, 200 basis points, that means I have to go below even AAA rated companies. So that will make my portfolio illiquid, and it will limit my ability to manage interest rate risk, right? So by investing in government bonds, I have more flexibility, even with PSUs, which is actively traded in the bond market. I have more flexibility to respond to macro events and interest rate markets. But if I'm investing in, say, illiquid double A rated bond, that will make my portfolio liquid. I won't be able to churn my portfolio at an appropriate time, and it will have its own consequences, right? So again, as I mentioned, it depends on the portfolio strategy of the scheme. And in this fund, our strategy is to manage interest rate risk, not credit risk. So we try to keep our portfolio most liquid and in the safe government and public sector issuers. Now, another point to add on this, this is not directly linked to this question, but there are some issues with the credit market in India. These are structural problems with the market. If you look at the total size, the secondary market of these bonds, how much they are trading in secondary market, we hardly have any trading in these kind of debt securities compared to the outstanding total outstanding of these bonds. So now that poses a lot of risk for investors who are investing in these bonds in terms of getting liquidity, especially in times of stress. And that's what we saw during 2020 crisis, when liquidity dried up completely and people were not able to sell those bonds. It's not just about selling and liquidity, it's also create problem in churning your portfolio. So if you are invested in, say, AA bond, and when you invested, you had a very good credit environment, right? And suddenly you can take a case of early 2018 or 2017, when everybody was buoyant about NBFCs, how they were growing, and there are a lot of talk about that, and they'll continue to capture that space from the banking system. But suddenly in 2018, IL&FS happened and everything changed, the entire narrative that changed, right? But the issue is, whenever that change happened, if you are invested, you have no way to react to that. You can't liquidate that portfolio because there is no liquidity. So that is a big challenge. So if say negative news flows come, negative things happen in the credit market, you have to take those losses. And that's what we saw that time. Secondly, most of the credit segment in case of India, we can describe credit as anything below AAA, because we have even seen AAA's defaulting. So that's a bit of worry. So most of the credit market or high yielding bonds, they are more linked to equity than debt. So whenever we see economic cycle turning, we have a weak economic growth, and companies are facing problem in terms of raising liquidity. You see these segments performing poorly at the same time when equity is performing poorly because of weaker economic growth. So it doesn't offer you that diversification benefit. Means the whole idea of investing in the fixed income space is to get diversification, and it can't deliver that diversification at the time when you need the most, right? So you need that diversification most in times of stress. And in times of stress, we have what we have saw is that the credit market has performed poorly. So these are some structural issues. There is also very high correlation. So the diversification within the credit space, that doesn't work. We saw that in lemon crisis. I mean, the whole idea of giving AAA rating to mortgages, mortgage-based securities, was that one entity default will not have any effect on the other entities. But it doesn't work that way. When we saw a lemon happening or the IL&FS happening in India, entire credit market flows. Means even AAA's companies face problem in raising money, and we saw further defaults happening. So it has a cascading effect on the entire market, and that can create problem for investors. So I think these are some structural issues with the credit market, and one should keep these things in mind when they invest in credit fund or invest in bonds directly of these companies. Yeah.
Thanks, Pankaj. What is the past 3 years returns for Quantum Dynamic Bond Fund? and its tax implication?
See, last 2.5 years have been very challenging for the bond fund, any bond fund, for the quantum dynamic bond fund. I guess returns are closer to, maybe our team can provide you that exact number, but return has been closer to 6%, and maybe slightly below 6% for the 3 year, because we had a big mark-to-market impact in the last 6-7 months, which is very recent, and it will take some time to smoothen out that effect. So it is closer to that band, around 6%. And if you look at the tax implication, if you remain invested for more than 3 years, the taxation is 20% with indexation benefit, and that indexation has a huge impact on your taxation. It reduces your tax liability significantly. So if you look at the after-tax return, it will be significantly higher than what you get in fixed deposits.
Next question is, if there is a 50 basis point decrease in repo rates, how much increase in yields we can have when the cycle turns downwards?
It depends on what kind of duration you are running that time. But let's say a simple math is that you multiply the yield change with the duration, and that's what will be your impact. So let's say if you are invested in a portfolio which has a 3-year duration, and you see 50% decline, you will get 1.5% change in market prices. Now we are talking about decline, that means 1.5% increase in the market prices. So one, you are getting yield, some yield on your portfolio, let's say 3-year bond. So you have a 7.2% as a starting yield, and then you add another 1.5%. This is a rough calculation to get a sense. And so 7.2 plus the 1.5, your return should be somewhere closer to that.
Yeah. There is one request to show the slide where we are showing the returns of gold, bond, and Sensex.
We have a question. Any question on that?
No, just it has requested to show that particular slide.
Sure.
Next question is, what should be the ROI expectation for following debt categories? As you have already mentioned about liquid funds, it's around, gives around 6%. Will you be able to comment on FMPs, target maturity fund, banking and PSU funds, floating rate funds?
See, again, it's very difficult to comment on future returns. Future is uncertain. We try to make a reasonable guess about future. And again, these funds, what kind of portfolio they have, where they're investing, that will make a lot of difference even within those categories, right? So very difficult to make any guess. I think investors should work with a general understanding, general idea about how fixed income returns have been when we had a starting yield around this level. And that's what I have tried to show in that slide. I'll show that slide again just to have that view clear, because we have discussed a lot about it. So as you can see, the 3-year, when bond yield was around 7.5%, you see most of the dot in this band, which is this is 3-year forward return. So if you are investing when bond yield was 7.5, your return has been between the 6% to 10% most of the time, right? There is a wide dispersion, but roughly in this band it should fall. And now in this environment, when bunch of the rate hike has already happened, now my guess is it should be closer to the higher side of this band, at least in the upper half of the band, and that's my guess. Now, if you are investing in different kind of portfolio quality, not into government securities and various kind of credit exposure, your return will change based on how much credit risk is involved. And so your risk and return both will change accordingly. So very difficult to give you any number, but I think broadly investors should work with this framework that this has been the historical band, and anything in this band I think is a will be very good number for the next 3 years.
Thanks. Next question is, my belief is inflation will stay elevated for an extended period of time, 3 to 4 years. What should be the strategy be if this come true?
See, if that happens, means if it remains elevated around current level for next 3-4 year period, we will definitely expect Fed and the RBI to be much more hawkish. So the policy rate, the repo rate or the federal fund rate can go higher, right? So the whole idea now is that we have already front-loaded the rate. Now it's time to recalibrate, just see the impact, because monetary policy acts with a lag. So when you hike, I mean, normal studies shows that it should take around 9 to 12 months for the impacts to go in the economy. So when you have already hiked, you reach a point where you just sit and see the impact, how it's affecting the economy, and then you try to recalibrate your strategy and be reactive rather than being proactive. So if RBI or the Fed, they see inflation meaning high for longer period, we will probably see more rate hikes coming, and that will be a time when we have to change the strategy. But it won't be single factor, right? There are other things are also in play, and bond market is kind of ahead of RBI or any policymaker in discounting inflation. And we have seen that in past. Even if you remember 2010-11, who have followed in the market, followed market in, during that time. So coming out of 2008 crisis in 2009, towards late 2009, we saw inflation picking up gradually. Though RBI was very conservative, or they were kind of reluctant to hike rate, bond yields started moving higher, right? So because bond market saw that inflation is going up, and similar thing we saw in 2021 or even at the start of 2022, that bond market was kind of ahead of RBI. So RBI was not hiking, but market reacted to inflation. So now what we see, or the market sees, is that inflation has peaked, and probably we are seeing inflation trending down. But if that narrative changes, that the baseline scenario changes from inflation remaining high, probably we'll see bond yields moving higher further, and then we will respond to that. And that's the idea behind dynamic bond fund, that if we see that happening, probably we'll again go defensive and wait for inflation or the monetary policy cycle to stabilize. But as of now, our estimate is that probably we have already seen much of inflation worsening, and for the next 2 years, probably inflation will come down. Yeah.
Next question, Pankaj. What is your take on target maturity funds, and are they better than actively managed funds?
See, it depends on how you see that. And again, the main thing, or the crux that changes in that target maturity fund, I mean, apart from the transparency on the portfolio, is that investor psychology. When you invest in target maturity fund of say 5 years, sometimes at the back of your mind, you get a sense that, okay, I'm investing for 5 years. But when you are investing in active fund, you tend to see your NAV on daily basis and get nervous if you see losses. So I think first thing that the major difference from investors' point of view is the investor psychology itself. So you have to beat your mind there. Now, on the portfolio management side, I think we get a better flexibility in open-ended fund. means a general open-ended fund, especially like fund like dynamic bond fund. And in this environment, this has a lot of value. As we discussed that inflation may surprise, right? This war in Russia-Ukraine can intensify again. Maybe we'll see another war. So, or some new COVID outbreak or something like that. Now, in this fund, this flexibility of changing the portfolio based on market circumstances, that has a lot of value in this environment. So I think this adds value. But yes, if you are investing in target maturity fund for that time horizon, you have more clarity about your possible outcomes. And but if you are investing even in open-ended bond funds, I think you get reasonable understanding about possible outcomes, and this is what this chart shows. So I don't see much of difference except for the investor psychology itself.
Thanks. One more question. Does any of our debt fund invest in bonds of UPPCL, APRSDA, etc., that yields over 9.5%? Agree, transactions. Yeah, there's a continuation of question. Transaction size is minimum 10 lakhs and liquidity is low. You can still allocate a small portion of your asset in dynamic bond or a credit risk fund. There's one more continuation to this question, like do we invest in bonds issued by private parties and yielding over 10%? So the same investor has asked both the question.
Okay. So first thing, this issuer is not part of our credit coverage. So we have a very limited set of issuers where we are very comfortable in terms of their credit quality. So even in PSUs, we don't assume that all the PSUs are safe, and we have been very rigorous about assessing even the PSUs for their credit risk. And there are a very limited set of PSUs where we invest in the bond fund and even in liquid fund. And same with the private exposure, as I mentioned in my presentation, that both in our fund, in quantum liquid fund or quantum dynamic bond fund, we do not invest in private corporate debt. So there's no exposure in private corporate debt.
Yeah. Do quantum liquid fund have an instant redemption facility?
Yes, it does have an instant redemption facility of up to 50,000 or the 90% of your investment, whichever is minimum.
What is your outlook going forward next 3 to 5 years for bond investments in India in contrast to debt instruments in developed economies?
Yeah, I think see, that's a good question, and that's a big thinking point, talking point across the globe. That if the US starts offering 4% on their government debt, who are going to invest in emerging markets, right? But look at Indian market, compared to or in contrast to our equity market, fixed income market has a limited participation from FPIs. Foreign investors, they own less than 2% of our debt market. So we are not relying on foreign flows in our debt market. That is number one. So secondly, our market dynamics, our inflation or the fiscal situation is very different from what they are dealing in the Western world of the developed economies. And that's what I think market is appreciating. So if you see the spread of US Treasury and the Indian government bond, that has actually shrunk because market appreciates that inflation. India does not have that kind of inflation problem what US is dealing with, and they are okay with relatively lower yield when we compare it with the US Treasury, movement in US Treasury. So I think this decoupled market environment that will continue. I don't see any reason that changing. But yes, probably we will not get much of flows from foreigners into Indian debt till the time we get interest rates in developed economies coming down. But even in US, now the starting yield, I don't know when they saw this level of yield, right? 4% on US Treasury. It has been more than 10, 13 years. Before Lemon, we had, they had this level of yield, but never after Lemon. So, and similarly for many part of the Western world, other developed economies. So there also investors have a very decent outlook for fixed income. Means the 2-year Treasury yield closer to 4.5% is in dollar terms. Investing in US dollar, investing in US government debt, you can generate 4.5% if you hold for 2 years. So that's a very good return for any dollar investor in fixed income. So they also have a very good outlook, but I don't see that's going to affect India too much. But yes, if Fed continue to hike significantly at a very fast pace, it will create turbulence around the world. And I don't think India will be immune. We have some buffers. We have a very high forex reserve. We have a very low foreign debt. So we have a good setup here, but nobody's immune if US Fed hike very sharply. So, but now from investors' point of view, I think again we should look at these two very differently. I don't see a high US Treasury rate affecting Indian bonds too much at this stage.
The question is on FD basically. When will the deposit rate pick up, and which is the better for long-term investment, fixed deposits or debt funds?
Yes, so in this cycle, banks have been kind of reluctant to hike deposit rates. One reason could be they had a lot of liquidity and there was no credit demand now. But now that liquidity is drying up and they have a credit demand. So most of the banks have started raising certificate of deposits. That is a kind of bulk funding, and that comes at a higher cost. So we should expect deposit rates to pick up. But I think that process will be slow. It won't be very fast pace in terms of deposit rates. But for the bond market, because bond market is forward looking, so they don't wait for RBI to hike rate. They look at the forward inflation and price it accordingly. So their yields have already moved up. Now in this environment, I think fixed deposits have to play some catch up, whereas bonds are better priced. They are already pricing a lot of inflation and monetary tightening. So I think this stage, in terms of their return potential, maybe bond funds are better placed. But again, it depends on how investors see these things, and every fixed income instrument has their own advantages and disadvantages. So you don't get a fixed interest or fixed return on your bond fund allocation. Your return will vary, though you can reduce their variation by holding for longer period. You can narrow it down, but it will fluctuate.
Shall one buy ULIP or other life insurance policy where there is a guaranteed return along with 10D tax exemption?
See, I'm not expert on ULIP, so I won't be able to comment on that. But maybe we should make a proper comparison of that and other limitation or the risk reward dynamics of ULIP and the mutual fund. But in my understanding, there is a big difference between their risk return dynamics between the ULIP and the debt mutual funds. But again, I won't be able to comment. I'm not expert on that.
Thanks. There's one question. What should we do when interest rates are rising?
So the best idea in the rising interest rate environment is to keep your maturity low, be it bond or the bond fund. So if you are investing in bond funds, actively managing that exposure, if you are in dynamic bond fund, your fund manager will do that. But if you are actively managing your allocation, probably in a rising rate environment, it would be better to be in liquid fund or the money market or those kind of categories. But remember, whenever we have this rising interest rate environment, you will see very low return on those categories. But that time it will be better that you remember rates are rising. So maybe over the period, long-term bonds can underperform short-term categories. But yes, the rule would be that you invest in shorter maturity bonds, which can mature frequently, and you can deploy the money at a higher interest rate.
Yeah. What is the duration of a cycle from top to down to again top? Any trend chart so that investment duration could be decided or play a cycle? Is the quantum dynamic bond fund good to play the cycle more accurately?
Normally what we have seen in our analysis that rate cycles have been between 3 to 5 years. So maybe the RBI's hiking cycle can vary, but if you see the bond market cycle, it has been in this span, mostly near 3 years. So within 3 years, we see rate cycles normalizing, and same with the bond fund return. So and that's what this chart shows, that what is shown on the screen, that returns have normalized, and then the band of outcome is very narrow if you remain invested for 3 years. So yeah, this is what we have seen in the past track record.
Okay. In case RBI increase the rate at a higher speed than expected, will floating rate fund be a good choice?
Yeah, if they continue to hike at a very fast pace, floating rate funds can outperform. But if we go by the baseline scenario where we are expecting that RBI will stop by 6.5, and this is, I think, kind of a consensus view where almost entire market has a similar kind of view. And we also have some signs there, because if you see the latest monetary policy minutes, 2 of the monetary policy members, MPC members, who vote for a rate hike or the change in interest rates, they actually advocated to stop hiking. And my sense is in the next meeting, probably they'll vote to pause the rate. And also, we will also see more committee members voting against aggressive rate hike. So there's some sign that RBI, means within RBI, there is a thinking that we should not hike too much, or we should wait to see the impact, because the economy has not recovered fully. Our absolute GDP is still below pre-COVID trend. We are growing below potential, right? Even with, if you remove all the base effect and the math, and look at a normal quarter growth, it has been in the range of 4 to 5% as per the RBI estimates. So they have to strike a balance between inflation and growth. And I think at some point, growth can become a bigger concern than inflation. So I'm not expecting that. That's not our baseline scenario, but yes, it can happen. And if it happens, then definitely floating rate bonds can do better than fixed rate bonds. But in our baseline scenario, I think floating rate bonds are better priced. And I see a better potential in floating rate. Fixed rate bonds are better priced. So I see better potential in fixed rate bonds than floating rate.
Yeah. One question regarding your view on MITs and credit funds.
Again, as I expressed earlier about credit funds, that overall macro environment is kind of healthy for credit funds. given growth is recovering and I mean, in general, corporates have deleveraged over the last 2-3 years. Banks are in better shape to lend. So all those things are kind of positive. But again, there are some structural issues with the credit market. And as I highlighted earlier, that you're not able to diversify. It doesn't give you diversification benefit, especially in a stress environment. It doesn't allow you to liquidate and churn the portfolio. And it has a cascading effect on the entire segment, right? So you see one default, and suddenly you see other issuers also getting into panic. So, there are structural issues, and I think investors should keep those things in mind. You may not see these happening every day, but whenever that happens, it has a huge impact. It's like I mean, you don't see airplane facing an accident daily, right? But if your flight faces that accident, the possibility of survival is very low, right? So if you are riding a cycle, maybe you'll fall daily, but you get some small bruises, right? So it's like that. In interest rate, it will move up and down. You'll see all the fluctuations, some positive, some negative on daily basis. But credit, you may not see it daily basis, but whenever it happens, it has a big impact. And if you remember in 2020, there were returns to the tune of -30, -40, -70% in some of the funds. Now, you don't expect that to happen in your fixed income allocation. And that's what I'm talking about. So if you, the impact could be very severe, and we should keep that in mind.
In continuation of that question, your view on MIPs, basically, monthly income plans?
See, again, I mean, I won't be able to comment on that, but yeah, this is one of the tools. You can have the diversified portfolio and make those withdrawals, or invest on a monthly basis. All options are available. But and I have nothing to add on this front.
Yeah. Last two questions, Pankaj. How would the fixed income react after 2 to 3 years time frame when RBI cut the rates?
Yeah, if they cut rate, that will be positive for duration funds. So you'll see long-term bonds performing better. Whenever interest rates fall, you see market gains on long-term bonds, and then that enhances return. So if that happens, that will be positive for long duration bonds, or the dynamic bond fund is one of the category where we can have very long duration exposure.
Last question for the day. Okay. Interest rate in US, Europe, etc. have moved up. How will that affect India?
I think I've already answered that question. So again, that I think both the markets have different dynamics, and India is not that linked to Western world. Our inflation dynamics is very different from US and Europe. So I think India will remain decoupled. But yes, if they continue to rise significantly, there are macro stability concerns which will resurface, especially on the external side, because we have a high current account deficit, and our currency can depreciate. So for investors, especially foreign investors, they will face losses on their India exposure because currency is depreciating. Other than that, it makes funding our current account a little difficult. And, still, we get some money through external commercial borrowing. NRIs invest into India, they send remittances. If they get that high rate, in their current destination country, probably the remittances, etc., will fall. So there are macroeconomic consequences if they continue to hike, and to that extent, market will also react. But directly market link, I think the direct market link is, I think, very weak at this juncture. Yeah.
Thanks, Pankaj. With this, we will end our Q&A session. Any closing comments from you, Pankaj?
So again, I think I'll just take to the asset allocation part. I think we should look at a diversified asset allocation, though this presentation was about fixed income. But remember, we have a very high exposure. I mean, say India on average has allocated a lot of their saving into fixed income. If you include all the fixed income instruments like fixed deposit, the PF, PPF, etc. So it becomes a large chunk of the portfolio. So I think Indian savers should look at diversifying their allocation and maybe increase their allocation to equities a little more, given its track record. Means we are a young country allocating very high into fixed income. That's not optimal solution, but maybe there are psychological or the past what we have seen in market that is affecting and that is making us allocate that way, being conservative. But I think this 12, 20, 80, if you focus on that and try to build your investment portfolio, your saving with that route, probably that can enhance your saving pool a little more and will add value over the longer term. And that's what you see in their return. So the strategy return is closer to 12.66%, which has significantly outperformed fixed deposits and many other saving instruments. So again, I think this is one thing we should investors should look at. And at Quantum, I think our team has done a phenomenal job in creating that platform. I mean, I really like that. And we should actually check. I mean, whoever has not checked, I request you to go on Quantum website and check that calculator and how you can customize your asset allocation and even invest in a few single clicks. I mean, a few clicks. So you don't need to go to all the schemes and invest. Just 2-3 clicks and you are done. So go check that calculator on our website, and I think that's it. With that, we can maybe close the presentation.
Yeah. Thank you for your valuable comments, Pankaj. To know more about our 12-20 80 asset allocation solution, we'll request all our listeners to visit our website www.quantumamc.com. Also, further, for any questions to be answered, you can write to us at customercare@quantumamc.com. and we'll be happy to answer the same. Once again, thank you everyone for giving your valuable time. Stay safe and happy investing to you all.
Thank you. Thank you, everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.